Update from the business cycle model of European stocks, and I may mention a little something of Asia, China, Japan stocks. I'm Rich Paz for Critical Point, Tuesday, February 11th, 8:53 a.m. Eastern Time. This chart is a weekly chart of the fund of the Ultra MSCI EAFE, symbol EFO. It gives you twice the profit, twice the loss, and it's European stocks. Level 1 bottom. January 13th, rallies. It's in the time frame for a level 1 top. It's met all the minimum requirements, even moving now towards the ideal. It could stay up another 2 to 3 weeks, which would make it late more than ideal requirements. But I think if you see a negative reversal week, and that is up, down, all the same week, or just a down week, and I'm not talking about slightly down, but something that sticks out on the chart that, hey, that is a down week. That's a level 1 top. And I think the market moves lower into March for level 2. Now, this is a similar timing of the U.S. stock market, which shouldn't be unusual. Most of the global markets tend to trade along with the U.S. market. Okay, and then their correlation really is how high, how low. They can be quite different. But the interesting thing is some of these level 1, level 2 patterns, time-wise, they can be very similar to the U.S. Okay, and even if they have totally different timing in the U.S., you'll still see the same type of pattern. If it's a fairly liquid market, it just does it at different times. So at any rate, a little gap up this week for that fund, much like what we saw with the S&P 500. I think ultimately it's pulling down, but we may have seen minor long-term bottoms for some of the European markets and even globally ahead of the U.S. The U.S. has not found its bottom yet. I don't think it's going to occur till May, June, July, and it may not even occur till as late as October. So it's vulnerable to things breaking, surprise down moves, and things like that. But the European markets, some of them are shaping up that they might have placed a bottom and are actually bullish now into 2026. Now, it may be a struggle, and I'm not implying that there's something about the European markets that believe they can shrug off Trump and tariffs and they don't have anything to worry about. I do think the ECB is going to print more money and make it more available, try to help grow the economy, give it some risk protection there, and perhaps even to help fight off some of the problems with the U.S., okay? But at the same time, there's something else going on there, and I want to give the bulls a chance more than the U.S., but I may learn that in the end, it just fluctuated along with the U.S. and didn't work out all that well. There is a gap that's still partially unfilled. That might be a downside target going into that level 2 bottom, but I'm leaning more towards there's a chance some of these European markets can outperform the U.S. for a little while here, and I'm thinking globally might outperform the U.S. Globally as a group. Now, this next fund is the Ultra FTSE Europe 2X fund, symbol UPV. Same story, starting to look for level 1 top now in the next few weeks. Down week will probably be the sign of that. It's rolling over, trying to go for a sell signal. It's overbought. It's warning it can be a little bit of a intra-year type overvaluation, kind of ahead of things a little bit. And it can pull back in the level 2 bottom in March. But here again, that level 1 bottom placed a few weeks ago might actually be a minor long-term bottom as well, that the European markets might not have as much downside as U.S. and maybe even a little more upside. All right. So those are two funds I'm going to be speaking more of in the future, and I may add some funds as well here as some kind of alternate or diversification type trading and how we can use the model to help with that. So next up, what I want to do is go to Italy, a monthly chart. This is a fund of Italy and minor long-term bottom, and I think it's going higher into 2026. It is due for setback by March. Can be somewhat similar to the U.S. forecasts along the way, but I think it's looking good. Now, I will say my global market analysis does not include as much fundamentals and economic data as it would for the U.S., okay? So a little more bias towards technical chart, price patterns, but I do look for some things. So at any rate, use this type of analysis as just backing you up or as a starting point, and you want to do additional investigation. Now, this is the German DAX index. And I am puzzled what's going on. In theory, last year it was a minor long-term top, minor long-term bottom. It's higher into 2026. What I don't understand is for 2 or 3 years now, people have complained Germany just doesn't have it for a growing economy. They got too many problems, complications, and yet the stock market continues to move higher. There must be a bet there that they're going to get through it. It's all going to work out. Or at least there's going to be money printed making the stocks worth more, even if the economy's not worth more. I don't know. So I know less of that and a bit puzzled with it. But frankly, that's a bull market. Trend is still up. Okay. I'll throw in India here, even though I'm bullish India for a couple of decades. And then after that, Europe can be bullish late this century on some very big super cycle type stuff and rotations around the world. At least a moment, looks like it's still pulling back for the Sensex index into a minor long-term bottom. But it almost seems too late. There's something not quite right with that. And they do have issues politically over there, financially. I'm not so sure it's necessarily economic in terms of the middle class and poor, but they do have some issues to watch out for. China index, I don't think it's going to do much of anything for years to come, and we do have to be concerned someday there can be a blowout crash problem. Maybe it'll be a contagion for the world. But I wouldn't be surprised they're going to hold out long enough to kind of coincide with a normal global recession, U.S. recession by the end of this decade. But I do think upside's rather limited. And I'll tell you something, if you go back 10 years, you can't see that the China stock market ever did much to the upside. Why is that? I think their people are very interested in short-term trading, gaming. They're having fun with it. That's the retail crowd. But I think that spills over into the professional crowd, that they just don't have a lot of long-term type driver information nor people to really put their money into it. And then I do realize their economy has had issues ever since COVID, and they took too long coming out of COVID. There's problems there, and now the trade wars and tariffs, and they're trying to shift over more domestic use and production and this and that, while still trying to grab more of the rest of the global situation, but maybe less of U.S. and stuff like that. Get all that. And I get why that could be a headwind for stocks. But if you go back several years when China was the go-go country and everybody wanted in on China, why didn't the stock market do better than it did? I think it's because their companies actually pay more to the employees. They help local. They help for the country, maybe even help the world. Maybe they pay more taxes. I don't know on that. And I think they're doing far more research and development. I think they're just better run companies than in the U.S. even. The problem is, for stock investors, is there's less return to the stock investor. The return is to the country, the people themselves, and employees. I think it's a better run system, frankly. And I think we're going to wake up to that. It may take us a few decades to get there, but we're on path to it. I think the whole world's going to go for it. And there's just going to be lesser returns in stock markets around the world in the future, okay? But that doesn't have to be a bad thing. Basically, the Wall Streets around the world need to wake up to the fact a low-profit company under the new system might be just as well run as today's high-profit companies. Therefore, in the future, you pay just as much for that company, even though it's low profit. Now, the problem with that is you might not have enough money for buybacks to help actually support the market to be that profitable, so we could lose some there. And there may be an issue with more taxes, and they don't really do enough write-off of taxes. They don't spend enough on R&D and write it off. There could be some issues of why they're just not going to pay as much. But my guess is there's no reason for the stock market to not do fairly reasonably close to what we've been doing in decades. So I don't view that as a negative thing for the stock market at all. But we have to change Wall Street's attitude and how they value companies. We have to become more of wealth-oriented, not rich-oriented. Wealth-oriented means money is less important, but it's important. Jobs creation is a little bit different, doesn't have to be extremely robust. And the people are just healthier, happier, still creative and productive, however. And if you look at China, I'm amazed in the last 60 days what I have learned of their creativity, productivity, their machine works as far as how they make things. Something is really ramped up there, and the U.S. better watch out, because you can see there are cyclical studies saying for the next few hundred years, Asia is going to be number one in the world. U.S., Europe, North America, South America will be number two. That's the East versus West that was put out by Spengler 100 years ago, and he wrote a book of the decline of the West. Well, some say we're there. In my opinion, that decline, however, occurred from World War I into World War II, including the Depression, 1920s, Spanish pandemic. That was over. Why do I say that? Technology has exploded from World War II to today. Okay, just unbelievable the things we've accomplished. Even in agriculture, a cow used to produce 20 pounds a day, produces 100 pounds today. Corn, 20 bushel to the acre, produces nearly 200 bushel an acre. Just tremendous, something to be very, very proud of. You know what was most of that period, though, from then to today, is really more government research, government money, printing money, building the economy, and an attitude of we can get along together and let's get out there and invent stuff and create stuff and get stuff done. Today, we're narrow-minded of just a few people run the companies and a few companies run the nation. And that's really crippling, I think, our creativity, that we don't have a broad enough mind of what can we invent next. I also think we're just forcing people to work hard, be creative, be productive, and that takes away from actually working smarter. We're the ones slipping, and you can just see Asia is repeating history of every 500 years it's Asia, and then the next 500 years it's everybody else, and then the next 500 years is Asia. We're repeating that. If we can keep some globalization and get our head back on track in this country in terms of we're mentally, physically ill, in my opinion, I think you can find we can come in number two and be very happy, very productive, very creative, close number two. And I think Europe, North America, and South America can catch on as well. These are some of the things we need to catch on with right now. Now, Europe has some characteristics already of a little more like Asia and a little more of China, and it may be because of some of the socialistic instinct. But really, Europe, that doesn't add up socialistic, in my opinion. I think we've been lied to in this country. They're really not. But they have a little more characteristic than, say, the U.S., but I think they're better positioned that European markets may not make as big a profits as U.S. and Asia, but the people actually will be better off. Someday that comes back to haunt the U.S. So it's the U.S. needs to change more than anyone, but I think Europe, North America, South America also need to take a look at these things to make sure they're not going to be such a distant number two compared to Asia, and are feeling poorly, or not having a good time. And it can turn around that way where we do not have a good time for a few hundred years, believe it or not. We also have to keep an eye on feudalism. That comes and goes. It might be a part of like a 500-year phase, but I kind of feel like it's more short-term, comes and goes. It just simply ties in right at the moment with the U.S. of all this fascism, the politics, the neoclassic, the neoliberalism, that's all burning out, capitalism burning out, everything's self-destructing in the U.S., okay? And the feudalism is, we're being run by too few companies. As I told when I was 15, 16 years old, I even told my father and some business people one night, they were meeting and they were complaining, we're all going to work for the government. And I said, what makes you think you're not going to work for the big business or government? And they all said, yeah, that's a possibility. Guess what? We're there, right? All right, so at any rate, I don't particularly care if China doesn't do that great. I think on the stock market, I think they're going to do great for their people and be a type of leader of the world here. But at the moment, it looks like their stock market can actually pick up maybe into next year. This is a Spain fund. Now, some of these funds I do have a problem with, that I'm not good at hedging on the currency side. So you can be all excited that I'm going to buy that country's stocks, I'm going to make boatloads of money, and then later you find out, well, I made about half the money. What happened? Well, you could be robbed by currency. You're converting it into your own country's currency. So you might want to look at funds that are actually hedged. Now, many years ago, I read an article that funds for India were saying they pretty much learned you shouldn't really be all that concerned about whether or not it's hedged or not. I'm not so sure about that, all right? Anyways, this is a Spain ETF here, EWP. It's not leveraged. It's not 2X, and I prefer the 2X stuff. I want to make a bigger bang because I'm not a stock picker, and I'm willing to take on the risk for that, and it helps me compete very well with the stock pickers. I beat 70 or 80% of them, in my opinion, and I don't pick stocks. It's great. It's wonderful. All right. Anyway, this fund looks really good to me. I think that particular Spain fund is moving. But let's now look at the Spain fund or index and look at that. The index is doing much better than the fund. All right, now is that currency related between the euro and the US? I don't know. I haven't done the research. Don't particularly care right now. But it might be something you want to dig into if you're interested in that kind of thing. But anyways, this looks really good to me. I think Spain has seen a minor long-term top, minor long-term bottom last year. It's over and done with. It's up and away, happy-dappy. It's probably going higher into 2026. And I think they got their act together. They're taking care of their people, but they're still doing profitable business, but they're making sure the business is taking care of their people. All right? It's not one-sided narrow-mindedness like we have in the U.S. So I think they're going to get rewarded and rewarded well, and they deserve it. I'm very happy for them, and I'm great about how this index is going. That doesn't mean it can't have sudden setbacks because of the tariffs and dealing with U.S., but on its own, it really deserves higher. I think it looks really good here for Spain. I'll throw in Japan. Japan's had such a good run. I'm very, very happy for them. After 20 or 30 years going nowhere, they've finally broken out. They woke up. I think they're going to have better connections around the world. They have to because their population's going downhill and getting older and older, so they've got to bring in younger people around the world and network. And even with Trump in the last couple of days, they've been here saying they're going to invest more in auto companies here in the U.S., and I think they're going to do it more in the Detroit area and that kind of stuff. That would be very helpful on a regional basis. Anyway, I think Japan has already seen a minor long-term top and bottom, but it was so wild and crazy with their carry trade blowout that was similar to our 1987 crash in the stock market. I know I might be pushing it, and some people can argue against me, but I think it was very similar. But I think they've over and done with it. I think they just need time to consolidate. And when it takes out last year's high for this index, this is the Nikkei index, if it does it this year, I think it'll be higher next year. But I wouldn't be surprised. They've already had one of the better runs for this decade. It may not be so profitable farther out, but a big change, and it's hesitating. I realize that can concern people. It bothers me. There could still be another knockdown for Japan before going higher, but right at the moment, I'm feeling on the friendly side of that. We have the Brazil index. It's really going nowheres, but it is up slightly. It's trying to hang in there. It's just really a short-term trader's market, and I no longer study enough to really get a handle on that. This is the Canada EWC fund. And despite all the trade wars, it looks like investors are rewarding Canada for standing up for itself against the U.S. It's actually up for the month, and it may be placing that minor long-term bottom ahead of the U.S. Fascinating, interesting, and when it takes out the high of last year and does it this year, it ought to be higher next year as well. And that's likely what will occur at the moment. But again, this whole tariff stuff can blow things up. It can cause even a secondary recession for the U.S. sometime 25, 27. Secondary meaning it's not that important. It may not even be called an official recession. It just comes close to it. But that could really upset the U.S. stock market, cause a contagion around the world of other secondary recessions and larger down moves. And all I'm going to say, if that would occur in the next few months for some of these European and global markets, if it knocks them down, we're probably just going to start over and call that long-term bottom anyways, and then I'll move up later, as long as we do see it's not an end-of-the-world scenario developing. So might be a little early on this bullish stance for Europe and maybe some of these European countries. But I like what I see. It's developing. I think it's working. And now let's go to South Korea. And South Korea is even turning up. I think they've got a long-term bottom. I think it's higher into 2026. And but again, it's just getting started. Things can go wrong, knock it down the next few months. It could even be like the U.S. and has problems maybe all the way to October, then higher. But it's trying. And it's just interesting to me. These countries are kind of waking up ahead of the U.S. is that a possibility? They think they're pretty determined. They won't let U.S. bring them down, let U.S. bring its own self down with all these tariffs, that they're going to somehow figure it out and pull it off. Interesting. Here's Portugal, one of my favorites. I visited Portugal. I kind of like their central bank, how they do things. They're rather quiet, really, in banking, financing, and business around the world. Their people are spread all over the world. There's probably Portuguese people in every single country in the world. It's just fascinating what they've accomplished in hundreds of years. But it's rather quiet. They don't try to overtake business, run anything, really. They just fit in. And from what I understand, a good-sized percentage actually go to France if they're professionals. Their country's kind of opening up again, allowing people in, and I think Europe is opening up more because they realize there's Americans that want to heck out and want to move, and Europe is looking for American professionals. All right, but I like this Portuguese. This is the actual index, and I think it's put in mind long-term bottoms going higher into next year. Here again, just getting started. Something might go wrong and give us some issues. This is the Canada index versus the Canada fund. Not quite as spiffy, maybe, but I think there's still a chance probably going higher in the next year. But this, I can see, that's a little too correlated to the U.S. It looks almost exactly like it. It may have to knock down into May, June, July like the U.S. forecast, and it may be lower still in October, whereas the Europeans, some of those look a little bit stronger, a little bit farther moving here. But moment, a little bit optimistic on Canada. I can just see something might go wrong there that's a little more problematic than what I've seen other times. And now I'm trying to go through my list and see if there's anything else we want to talk about. This is the French CAC index, but it's the futures. But that has rallied well enough. Very convinced it's put in a minor long-term bottom, put in a top last year. I say this is up and away into next year. Don't know how profitable any of these will be because Europe's normally the more profitable stock market, okay? But there could be brief moments that some of these other markets outperform the U.S. But I really like the look of this. I think France is going to do okay into 2026. But again, what could blow up in the U.S. that causes a contagion that blows up around the rest of the world? Always got to look out for that anyways, but this time more so than normal because we got to deal with the Maganomics and the Trump tariffs and the politics there that do interfere with global trade and industry and business, okay? And I follow a index of global trade from a company in Netherlands and made a forecast a few years ago. It was going to be bullish, moving higher, more and more trade around the world into the end of this decade and then fall for the once a decade sell signal in the stock market, once a decade sell signal for the economy, a recession in other words, and the whole world would be on the same page coming down with us. But the problem I have right now is slow, it's struggling, it has slowed down compared to 20, 30 years ago. Anyways, we just grew things a bit too fast. That you can just see there can be some issues that can back off that global trade here. Again, I wouldn't rule out some nasty drops in the next few years here. But overall, it's looking to be optimistic, the stock market. I just, on the U.S. side, I really need a minus 7% drop in the next few months, kind of clean some things up. Then I could become more optimistic and a bigger risk taker. But for those of us in the U.S., we got to keep looking over our shoulder. What might actually not be a correction, but something that breaks the back of the market. And that is mostly this tariff stuff, but it's also social, political, everything within the U.S. At any rate, to sum it all up, it looks like to me the world wants to move forward, print the money, get going, try to grow their economy. It's going to be a struggle at times. We've got this headwind and risk that's called the U.S. Okay, past results are not necessarily indicative of future results. Have a great day. Thank you.